main focus point today is about understanding ex-dividend dates and when you're entitled to the dividend. This is a question I get a lot, and it's important, especially when you're a dividend investor, you're an income investor. When do you need to own the stock so that you receive the dividend? Now, there are two important dates. One is the record date and the ex-dividend date. Now, the record date is when you must be on the company's books as a shareholder to receive the dividend. Okay. And the ex-dividend date is usually set one business day before the record date. Okay. There's also a pay date when you're actually getting the dividend. That's usually somewhere around 1 to 3 weeks later. Okay. 2 is probably average. And it's important to know how this works. So, for example, if the record date is on a weekend, it's going to be the first business day before that. So if it falls on a weekend, the first business day would be Friday. That would be the ex-dividend date. Now, you can't buy the stock on the ex-dividend date and expect to get the dividend. You have to buy it before the ex-dividend date and own it at the close before the ex-dividend date. Okay. So when the market opens on the ex-dividend date, you need to be a shareholder of the company. That's when you will get be entitled to your dividend. Then you get it on the pay date. And that's for normal dividends. Now there's also special dividends. Many companies do this. They pay big special dividends, oftentimes 25% more of the stock's value. And if it's over 25%, then it's a special dividend and other special rules apply. The ex-dividend date will be deferred until one business day after the dividend is paid. So, for example, in order to get that dividend, you will actually be paid a day before. Okay. And so you need to own it on that day. And sometimes a company pays a dividend in the form of a stock rather than cash. And if you sell the stock before the ex-dividend date, you are selling away your rights to the stock dividend. Okay, so if it's in a form of a stock, it's also similar to your standard dividend, right? You have to own it before that ex-dividend date. So I know this can be complicated, but to keep it simple, you don't want to be trading on these names around the ex-dividend date. It doesn't make sense. That's not what this is for, right? The dividend stocks are for more long-term buy and holds as opposed to trading. A lot of people say, I'm going to buy it before the ex-dividend date so I get the dividend and sell it. Well, usually the stock will drop the value of that dividend on that date. So really, long-term, what dividends are there for is to create discipline, not just for you, the equity holder, so that you consistently get that dividend, but actually for management. Because management doesn't want to be the ones who cut the dividend. And so typically they reserve that cash and they are more prudent with the excess cash left over that they can use for acquisitions or CapEx or anything to invest and grow the business. And that capital discipline is vital to the long-term success of the company. Because that's what return on equity is about. It's okay, how much of their earnings are they taking and investing it back in the business and then earning more on that money? And that's a big factor here that helps drive returns for dividend payers over the long term and companies that are prudent with the capital they're reinvesting in their business. Sometimes they can get over skis and make bad decisions, and that can kneecap the company long term. So dividends create that consistent payout, which also more often than not creates consistent discipline by the management teams.